And I want to get your guys' take on something that Janet Yellen said here recently. She said she would be amazed if Enber declared a recession. Now, of course, we know that Yellen has been amazed that we will also probably never see another financial crisis in her lifetime. But she noted that recessions don't happen when the non-farm payroll report is running around 400,000 a month. Now, Jeff, I know that you are a card-carrying member of Janet Yellen's fan club. I know you read her research every day, and you just can't wait to get it. So, as a big fan of hers and a big student of hers, what's your take? Is she right? Can a recession happen when the non-farm payroll is running this at this high, or is she about to be amazed?
You know, the old joke is that no AAA rated credit has ever defaulted. And the reason is because it gets downgraded 14 times before you ever get to that point. And I think that's kind of where we are with the payroll report.
Hi, everybody. I'm Roger Hirst. I'm the managing editor of Real Vision Creative Studios. And before that, I had about just over 2 decades experience working in the city at places like Morgan Stanley and Goldman Sachs as a macro derivative salesman on sales and trading desks. So that's my background. What I'm going to hopefully do in the next few minutes is just kind of do a quick summary of that brilliant discussion covering so many different facets and features, quite a lot of complexity in there. I'm going to try and sort of just boil it down into hopefully a couple of things. And I think really what this is all about, and also what Luke and Lynn were talking about yesterday in their discussion, is that this is really a battle between price and growth, at least from the Fed's perspective. From the market's perspective, it's a little bit more inflation versus recession. But let's look at the Fed first, because what the market's now looking for is, when is the Fed potentially going to pivot? Do this thing where they're on a tightening mode and then they go, you know what, we're off that. Things are broken. We're going to now potentially stop hiking and potentially we're going to start cutting again. That's what the market's looking for. That's the battleground. And we're in this fascinating scenario where over a 12-month period, and this is that whole Eurodollars curve that Jeff was talking about, the market's pricing in lots of rate hikes and it's pricing out lots of rate hikes within a 12-month period, which is quite unusual compared to the last 30 years. Now, let's just look at that from the Fed's perspective, because what's interesting here is that the Fed, in some ways, clearly went on to a price mandate at the end of last year. And I say that because for 20, 30 years before that, particularly from the late 90s, the Fed was always focused on growth. Every time they saw growth roll over, and often the indication of that was the equity market, they went, oh, growth's a problem. We're going to support growth. We're going to cut rates. We're going to do QE. That was the Fed's kind of quasi mandate, at least the one that they publicly thought they want the public to believe in. But then at the end of last year, they went, we're now focused on price. We're focused on capping price rather than supporting growth. And that's a key definition, because what we're saying here is if they pivot, they're moving away from price. They're going to say we're no longer bothered about price. And the market has been in this scenario as well, because the market was pricing for inflation, for higher price earlier this year. But more recently, over the last 3 or 4 weeks, it started to worry about recession. It started to worry about growth. Now, one thing I want to put out here, because there's a lot of debate or a lot of discussion from particularly Jeff about inflation. And a point of clarification, which is that in the word inflation is a horrible word, because it has, in its sort of purest textbook form, it's very, very specific. But the reality here is we're not talking about necessary inflation. We're talking about price. Now, I use them interchangeably, but actually forget the word inflation, even though I'm going to use it. Think about price, because you can have high prices without true inflation. But me, you, my mum, dad, dogs don't care. What we care about is, are prices high? Are those high prices a problem for growth, a problem for living standards? And is the reaction function from policymakers going to be as if we had true, proper inflation? And I think that's the issue here, because let's say this isn't true inflation like Jeff believes, but we have persistently high price. This is where that battleground comes into play. And the example of that is, if we can see the chart on CPI and recessions, if we can put that onto screen, I'll kind of quickly go through this because I'm going to use 2 distinct periods here. Now, for most of the last 30 years, we've been in an area or a region of moderation. And what I mean by that is we did have moves higher in prices, because CPI is consumer price index, can be inflation, might not be. It might be bottlenecks, but it's higher prices. But those prices tended to be following growth. So growth led, bringing up prices. When growth rolled over, the Fed reacted, cut rates, and did some support. That's what we saw for the last 30 years. We always saw this sort of very kind of moderate level of inflation. If we go back into the 1970s, however, it was very, very different. And whether today's high prices are for the same reasons as they were in the 1970s doesn't really matter if the market reaction and the policymaker reaction is similar. What you had back then is that you had much, much higher levels of prices. Now, what I want to show on this chart is the thing that they were talking about, and particularly Darius, is that when you get higher prices or moves in prices up to the upside like we've seen recently, you've always pretty much always been in or very near to a recession. 1970, 75, 80, 81, even 1990, 2008, you saw high levels of inflation peak in the middle of a recession. The only one that didn't happen was 2000. The peak was just before. And obviously in 2020 was an exogenous shock. So the point that we're all making here, or people have been making, is that when you get prices at this level, you're nearly always inside a recession already. And things move very, very quickly when prices are this high. But the issue that we have, the thing that Jeff was really talking about, is that the policy response, is that going to have an impact on these high prices? Because these high prices are largely caused by issues around supply. Now, that's not entirely true overall, because we had these very, very high levels of government expenditure, fiscal expenditure in 2020 and 2021. So the same time that we shut down our means of supply, production and supply, we increased demand, particularly for goods, and that caused a lot of the levels of high prices we've got today. The problem that we now have, and this is the battleground, is that if the Fed pivots now, and we haven't necessarily seen a peak in CPI, 9.1% is the highest level for 40 years. What if that's still not the peak? And they pivot in a way that means that they kind of support growth. And what if we don't get a recession? Because the thing about recessions is it's the recession that brings down those high levels of prices. And it's happened every single time. You get those prices moving up. And if those prices are killing growth, you want those prices to be destroyed by a recession. The prices come down, growth kicks off again. And this is really what matters today, is that if the Fed is convinced by the market to pivot, then you're still going to have a problem for growth, because what we've had, like the 1970s, is prices getting really, really high. And those high prices are what's killing growth. So if you allow prices to remain high because you're now worried about growth, well, you're still going to have a problem with growth, because those prices could go higher and still kill growth. So will the Fed necessarily pivot away from price today, or when they meet? I think what Darius was saying is that they need to kill price, whether it's inflation or not. They need to kill price. They almost need a recession. They need to break something. You need to tighten financial conditions to slow growth, to slow price, because if you don't cap price, you're going to have recurring problems with recession. And again, we can see this. If we can now see the second chart, and the second chart is CPI, Fed funds, and recession. Now, what's very unusual today is that we're pricing this sort of a peak in interest rates, and then they come down almost immediately, so an upturned V. And that's what we saw largely in the 1970s when you had those high levels of price. It was inflation back then. You saw these Fed funds going up to sorts of levels of inflation, and then you had the recession, growth falls, prices come down, the Fed cut rates, and those back-end yields fell. So this is what people are saying on the 10-year. 10-year yields should fall if we're in one of those recessions. And that's what happened in the 1970s, except when Volcker came in and said, I'm actually going to kill inflation this time around. And what you saw in 1981 is those interest rates, which is the black line here, those interest rates far, far in excess of price CPI, to finally try and kill off that inflationary issue. And then throughout the next 10 years, you basically had interest rates which were always above CPI. It's only in the last 10 years where we've seen that reverse again, like today, where we've got interest rates which are low relative to price CPI. And so this is that very difficult sort of scenario that we're in today. It's trying to work out whether the Fed is going to go, you know what, before we've actually got a handle on price, we're just going to let it go and risk prices moving again. In the 1970s, 60s and 70s, they kept on doing this. You'd have prices go up, they'd relent, they'd do their flip-flop. And by flip-flopping, they allowed those, they allowed basically a new level of price. So prices went up, came down in a recession, because the Fed relented. But then they went higher again, came down a little bit in the recession, went higher again. I think there's 4 waves of that in the 1960s and 70s and 80s until Volcker came in and did what he had to do. Is this the first, or is this a one-off? And people talk about transitory, which is a little bit of a difficult conversation. I think Lynn and Luke talked about this, which is it's not really whether it's transitory, it's how powerful, how hurtful the inflation is that really matters. It's been quite hurtful already. So this is that battleground. And I think it kind of goes into one other part, which was touched upon, which is we've been in this paradigm of moderation from 1982-ish, really through to 2020, 2022. Moderation being you had a downward trajectory in yields. Yes, you had spikes up during those growth periods, but it was a downward trajectory. From 1945 to 1982, we pretty much were the other way around. So we saw an upward sloping, rising kind of yields. But what if we're changing now from a world of moderation to one where we're going to see stickier inflation or stickier prices? I'm using inflation again, stickier prices because the world has changed. We're seeing a splintering of globalization. We're seeing significant and ongoing problems with energy supplies. Obviously, Europe's got a massive problem at the moment. And even if things normalize in that sense, you're still going to be very restricted on supply. We are nowhere near the demand levels of pre-COVID. China is still in lockdown. What if some of these demand issues start to pick up again when supply is constrained? You are still going to have high prices. Maybe we have structurally high prices. And the big thing for the Fed, and this is again, when we talk about this pivot, is that it's not whether we get a peak in inflation. That doesn't really matter. It's how much of a pullback that we get. Because if they're still targeting 2%, and we've got month-on-month increase last month of 1.3%, that's month-on-month, double digit over the year. You need to get down to 0.2, 0.3% month-on-month to be sort of in the ballpark of what the Fed really wants. Now, the problem also is that obviously, as everyone's talking about, is that markets are forward-looking, the Fed's backward-looking. The Fed's looking at data like unemployment, and you can see unemployment is always at its lowest just before a recession. So strong employment is nearly always a sign of imminent recession. In the 1970s, during that period of higher prices, you actually had your absolutely tightest employment level just as you hit recession. So the employment numbers are not a sign of a healthy economy, they're a sign of overheating, but it's a backward-looking indicator. And a lot of the problems that people had this year when they're predicting this to be a year of growth is that they saw nominal numbers like wage growth, nominal retail sales all look good. But actually, when you deflated them for CPI, for what was prices at that time, at this moment in time, real wages are low, real retail sales are low. And you saw that trajectory of GDP. We're nowhere near the old trajectory. So the problem is we've got these low levels of growth, but we've got these very, very high levels of price. And the Fed's mandate is still price. So the chances are, the expectation should be that we get 75 basis points. The problem could be that we still have high prints on CPI. What if the next print is 8.9? People go, well, the peak's in. But 8.9% compounded over a year is pretty horrific. If you've got negative real wages, i.e. your wages going up 5%, inflation 10%, you're worse off. You're worse off. And remember, prices need to come down in order for people to feel better off. So prices go up, and unless we get deflation, which we're not going to get anytime soon, unless we get a proper recession, you're not going to see those prices coming back down until oil rolls over, until all these other commodities roll over, which if you've got supply constraints might not happen. So this is the very real difficulty of the financial markets at the moment that we're trying to play with. Now, I think, how should people play it? I think one thing that is certain, and this is not me predicting any price or anything like that, but volatility is likely to remain high. These are going to be volatile times. We've got relatively high volatility in the FX markets, in the bond markets. Equity volatility is perhaps not as high as you might think, it should be. It's 24 in the VIX, and we used to be in the era of moderation. VIX would be 10 to 15. It's been up to 30, but the actual markets themselves are moving on a 24, 25 volatility. So it's relatively high. So volatility is likely to remain high, but the risk, and what we've got to try and get our heads around is the Fed going to be happy to pivot knowing that price is high? And it's backward looking, yes, but the Fed is not forward looking. But when it comes to the market, and this is one other thing to really think about here, is the Fed making a mistake? Well, the market is the one that caused the rollover. It was the market that priced 3.7% Fed funds, now at 3.4%. The Fed's not there yet. It's the market that priced that. It was the market that pushed 10-year yields to 3.5% and 2-year yields from almost 0 to 3%. Just the market that caused the wobbles. It's now causing the recession. And the Fed is trying to catch up with the market. So the Fed is nearly always behind. So should they now start looking forward at the slowdown in growth that's coming out of things like copper and the fall in bond yields, or should they be focused on price? It feels like they need to give some more messaging. But for now, I think we can say they're focused on price. They should do 75. And we need to see a proper breakage, as we saw in the 1970s, where you see prices properly coming down 5-6 percentage points. That's when they know they've got a handle on price, not just a 20% fall in the equity market and an ISM that's going towards 50. The ISM is the Institute of Purchasing Managers in the PMI, Institute of something, Supply Management, I think it is. These things are not yet fully in recessionary territory. So far, this has come from households and small businesses. It's the man on the street, it's the consumer this time around that's being hurt, which is why it's not shown up in some of the big data like yield curves, like the ISM, which is big companies. It's hurting from the bottom up this time round. And inflation hurts everybody. Weaker equity prices hurt a subset of everybody. And until inflation or high prices, those prices, there's a handle on those, until the Fed feels that they've done their job and visibly have done their job, they should remain focused on price. So that's the battleground. When we see the Fed numbers tomorrow, we should be expecting 75. Might be 50, might be 75. But I still think that they have clearly said we're focused on price, not growth. So they're not going to do a pivot yet. I think we'd still need to see a lot more downside, which is what Darius was saying. Effectively, what the euro-dollar curve is saying is we are going to get more downside in risk assets. But risk assets have been in a bear market for equities, but they've not been in a recessionary market yet. There's still a lot more work for financial assets to do to tighten financial conditions to truly bring down price. So look at the Fed, 75, and you probably say 50, 75 next time around as well, unless we finally get that final denouement in the equity market. We get a big sell-off and people go, oh my God, I want out of here. Yes, sentiment might be poor, but positioning is not as negative as people might think. So it's very, very hard. It's a battleground between price and growth, inflation, recession. The Fed's still sticking with price. The market's going for recession. Someone's going to blink. Won't be tomorrow. It's probably going to happen over the next 2 to 3 months. But so far, the Fed is still focused on that 9.1% CPI print and thinking, I've got to get that down. And more importantly, that 1.3% month-on-month print, that's the one the Fed needs to get down towards single-digit numbers, low single-digit numbers. So hopefully that helps. I didn't try and get too much into the weeds. I wanted to just highlight what the battleground is, where we should be focusing on. And the point is that this is uncertainty, and uncertainty is volatility. And that's probably the only thing that we can be semi-certain of in this environment.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.